ETF report, and we're going over the Consumer Discretionary XLY ETF, and this is for July 19th, 2025. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to invest even better than Warren Buffett does now. And the question is, why are we going over the XLY? And here's the reason right here. Because we went into the charts and we looked at some of the most active ETFs this past week. And what did we see? Well, we saw right here that black line is the S&P 500. And we saw that the XLY, which is this yellowish line, outperformed the S&P 500. And the XLP, consumer staples, and that is the blue line, it underperformed. And this is the XLB materials. And actually, they said the materials did very well this past week, and it did, but then it kind of petered out. And it all had to do with certain materials that we can get from China or can't get, depending on the types of metals they are used for batteries, and on and on and on. And you can see that it's sort of been in an uptrend, but so has the consumer discretionary. So what we're going to do is we're going to go to the computer program, and as you can see, it's consumer discretionary outperforming the S&P 500 and the staples and the materials ETF. So let's go there and let's see what's going on. And we'll go to the computer program. We go to our site, BuffettandBeyond.com, hit subscribers locker, and we will go down here to the ETF and individual stock database, all the way down here. And we will click on that, and then where it says click here to access the ETF, and we hit the ETF. Now you got to go all the way down here to the bottom where it says, click here to access the ETF, all the way down here. So let's click on that, and we will go to the ETFs right there. We'll look at the XLY consumer discretionary right here. We don't even have to put it in here. We could if you want. And so to find consumer discretionary, we have it right here, and you just click on that and it brings up all the stocks. So what do? We go to the 2026 ROE or the 3-year ROE. I like to do that a lot too. Click on it once and it goes from 0 to the highest or lowest to the highest, clean surplus ROE. Click it again, it goes to the highest, clean surplus ROE. Now, I look to see over here to the right, if this has a 32.8% clean surplus ROE, I go over here toward the left, and I also go to the right, but usually to the left to see how it's doing. And Amazon, well, do we buy into the consumer discretionary? We have Amazon in all our other portfolios, so we don't have to go there very much. Las Vegas Sands, we look at that, but the problem is the 5-year ROE, the 10-year ROE. So it's a little... And we're just eyeballing this. We are just looking at something that is quite cyclical. The gaming stocks and the gambling stocks, are quite cyclical. And we're looking at Airbnb, and we're still looking at Airbnb. Might be something good going on. Chipotle, we have Decker's Outdoor, we have Marriott, too cyclical for us. Lulu, look at the 3-year ROE at 21% here. And it has been slowly declining, and we've talked about this many times. It's not in our portfolio this year, and we took it out, I think, in the middle of, not last year, but the year before, because we just don't want it in our portfolio. It's got too much competition. Pulte Group, okay, it's in. And let's hit the 2026 clean surplus ROE from the highest to the lowest. Norwegian Cruise Lines, we look at that. Because some of you like to go to the 2026 right away. And I do too also, but I look at the 3-year and the 2026. And we look at 2025 was in the negative. The cruise lines just got hit because of COVID. So it's all over the place. We wouldn't even talk about it. Amazon, Las Vegas Sands, Chipotle, Airbnb, Marriott, and Decker's Outdoor. Booking Holdings, we've had in our portfolio before. Very, very close to being in there. And again, Darden Restaurants, it's in one of our portfolios, dividend and growth portfolio, Home Depot, McDonald's. So what we're looking at and what I'm bringing out is that there is nothing here that I like right now, that brings us to a point where I say, okay, I would like the consumer discretionary. I'd like to buy some of the top stocks in there, but they're all already in the portfolio. We've analyzed these all together, and so therefore we don't have to go any further on these. So a lot of you have asked about these stocks and this consumer discretionary over the past week or two because it's been on the TV a couple of times, and we just look at it, we say, okay, we don't need that. We have everything that we need in this group, in the highest group. And gee, we either have it or we had it, or it's cyclical and we really don't want it. So we really don't have to go much further. But let's look at Norwegian Cruise Lines just for a second. NCLH, Norwegian Cruise Lines Holdings. And we want to look at that. So we can go over here to big charts because some of you say, yeah, but it's really doing well now. So let's come all the way across over here and see big charts right there. It's in little letters. It should be in big chart letters, right? So click on that. And remember the symbol NCLH. And we'll click on big charts. And oops, look what comes up. Yeah. It's a chart of the S&P 500. So the S&P 500 is already there. So we come over to the left a little bit, and let's hit 5 years on the time. And we come down here, compare to, and that's where we put our NCLH. And down here, we want to get rid of these Bollinger Bands, the volatility bands that we use every Saturday, because that's what they're here for. So let's just get out of those. And you can see you have all sorts of things here. And let's hit draw chart. So here is the Norwegian Cruise Lines, which I've also been asked about. And this is the 5-year chart. So black line is the S&P 500. And this yellow line is Norwegian Cruise Lines. So Norwegian Cruise Lines has its highs, it's had its lows. This is a big drop in here, folks. And this is 2022, by the way, right in here. And we can see it dropped, and it has been underperforming the S&P all of this time because of the cyclicality and that it hasn't made money in these years in here. It was coming out of COVID, which is all the way to the left, 2020, and started coming back really, really strong, but still it wasn't making the kind of money that the semiconductors and the techs were, so they just sold it off, and when they started selling it, they really sold it. And the point I want to bring out is that rather than going into a stock like this where people are saying, hey, you know, it's almost as good as the S&P 500, you just buy the S&P 500, and then you don't have to put up with all the nonsense of how many people are on their cruise and did the people get sick from some food poisoning, or did they hit a storm and do they have to cancel a cruise and all that. You're in the S&P 500 and you're outperforming Norwegian Cruise Lines. And that was the other question that was asked of us, is what about Norwegian Cruise Lines in the consumer discretionary area? And we don't like the consumer discretionary because those good stocks that are in consumer discretionary are already in portfolios because they're in other ETFs also. So that's what we wanted to show you. So let's go see how our portfolios are doing. And as soon as I stop making you dizzy, we can go over here. And this was as of Friday afternoon. The QQQs are up 9.9%. In about the past 3 weeks or so, it's up about 2%. The S&P is up about 2 percentage points. And our portfolio is about 1.5 percentage points. But look at the top stocks, and this is the NASDAQ ETF top stock portfolio. So we liked this stock portfolio. This is what I use for my test account. I use these stocks, and I do various strategies that you see from time to time because this is actually my big test portfolio. And I like to use these stocks. So the stocks are doubling the S&P 500 even if you don't do anything around it. Now, in the portfolio, in the test portfolio, we were actually up 45% over the past 1 year. In other words, since last July to this July, right, mid-July last year to mid-July this year, we're up 45%. Why? because I did all kinds of testing in there that had to do with spreads, covered calls, things like that. So it really helps to do those calls and protections and things like that. But it's a lot of work, folks. That's why it's called a test portfolio. But even if you bought the stocks and went to the beach for this whole year, you're up double the S&P 500 right now. Let's go to the Sector Stars portfolio, and you can see that it is up 10.9%, up about 50% more than the S&P 500. So 10.9%, but it's actually down 0.5% over the past 3 weeks. And why is that? Well, Fair Isaac is the one to blame in here. And look at Apple. Apple's down 15% for the year so far. So we looked at Fair Isaac. It has not been doing us any favors, but we still have that in our portfolio. And this is the stock on which we, if you wanted to, took a tax loss on it by actually going in and buying, let's say you had 100 shares of it, buying another 100 shares, and then in 31 days you'll sell your first 100 shares that you bought at the beginning of the year. In our case, bought at the beginning of the year. And then you'll take the tax loss, you'll sell the first section of stocks or the first 100 shares of stock, and you can take your 22% loss on your taxes. And remember, that's the 31-day wash rule, and we went over that in our daily newsletter. So this was the stock that we did that on because it fell so far. Yeah, we don't like things like that, but it happens. And it's hard to get rid of this stock because the numbers have not gone down. They're just sitting there, and they're doing very, very well. And we kind of like this stock. So we'll see what happens. If it keeps going down, then we'll sell it at least by the end of the year. Want to replace it with GE Vernova we're looking at right now, and we have some questions on that, and also the new GE, which is called GE Aerospace, I believe it is. And we were asked why we didn't get into that stock, and there's a reason, and we'll go over it in our daily letter this coming week. So again, up 10.9%. And our top QQQ stocks, in other words, the NASDAQ 100, we picked the top stocks out of that. And what's performing terrible in that area is the trade desk. Yeah, and we just don't like the trade desk anymore. It's in advertising. Advertising has been slow, and so has the economy. Even though it's a pretty good economy, retail sales are really in the doldrums. Housing is in the doldrums, and therefore advertising and some cyclical stocks. This is a little too cyclical, but we thought the economy would be much better at this time. So here we are, up 14.5% for the year so far, doubling the S&P 500. So, folks, we had a pretty good week this week, exception of Netflix. Netflix beat on all sides, beat on revenues, beat on earnings, and the stock still went down. So you could see the topping action starting to take place here, but we still had a pretty good week. We had some spreads that we made some money on. We put some new spreads on Friday, and we just using that because we had to buy the October puts for our portfolios. And we just want to get the money, using the spreads, we just want to get the money in order to pay for those puts, the protection puts. So, folks, you go out, you have a good weekend. Most of all, stay safe, and we'll see you right back here in a couple of days.